International Financial Reporting Standards, or IFRS, set global rules for public company financial reporting. Issued by the IASB, these standards ensure consistency and comparability worldwide. IFRS 12 increases transparency about a company's interests in subsidiaries, joint arrangements, and structured entities. It consolidates disclosure requirements, making reports clearer for investors and analysts. Ultimately, IFRS 12 is about making financial relationships visible and understandable. Transparent disclosure is essential for healthy capital markets. IFRS 12 ensures companies reveal their interests in other entities, giving investors and creditors a complete picture of risks and resources. Without these disclosures, hidden relationships could mask liabilities or losses, leading to poor investment decisions and market instability. For example, undisclosed exposure to a struggling subsidiary could spell trouble for the parent company. IFRS 12 requires companies to explain the nature and risks of their involvements, including restrictions on assets or obligations to provide support. These details help users assess a company's true financial position and resilience. Disclosures also clarify the contributions and risks of individual subsidiaries, joint ventures, and associates. This granular information goes beyond aggregated numbers, offering deeper insight into operations. Ultimately, IFRS 12 empowers all stakeholders, investors, creditors, and regulators, to make better decisions and hold companies accountable. Clear disclosure fosters trust and discipline in the market. IFRS 12 covers four main types of interests: subsidiaries, joint arrangements, associates, and unconsolidated structured entities. Subsidiaries are controlled by a parent company, and their results are consolidated into group financial statements. Joint arrangements involve shared control, either as joint operations, sharing assets and liabilities, or joint ventures, sharing net assets. Associates are entities where the investor has significant influence, usually with a 20% or greater stake, but not control. Investments in associates use the equity method, reflecting the investor's share of net assets and profits. Unconsolidated structured entities are designed so control isn't based on voting rights, often used for securitization or asset financing. Even without consolidation, companies must disclose their exposure and risks from these entities. IFRS 12 requires details on the nature, purpose, and financial impact of all these interests. The goal: ensure users understand the company's web of relationships and potential risks. IFRS 12 demands companies disclose the key judgments behind classifying interests as subsidiaries, joint arrangements, or associates. This transparency lets users assess whether management's accounting choices are appropriate. For subsidiaries, companies must name them, state their location, ownership percentage, and provide financial summaries if material. They must also disclose restrictions on accessing assets or settling liabilities, and details about non-controlling interests. For joint arrangements and associates, disclosures include names, relationships, locations, and summarized financial data. Companies must reveal any commitments or guarantees related to these investments. For unconsolidated structured entities, disclosures focus on the nature, purpose, and risks of involvement, plus any financial support provided. Both qualitative and quantitative information is required to show the extent and impact of these interests. The aim: give users a clear view of exposures, risks, and the company's financial health. These requirements make financial statements more reliable and informative. Let's see how IFRS 12 disclosures work in practice. A multinational like Global Corp lists key subsidiaries, such as Euro Manufacturing Limited in Germany, and discloses ownership and financial highlights. For material non-controlling interests like an Asia trading company, Global Corp provides summarized financials and notes any restrictions on accessing funds. In a joint venture, say Tech Innovate JV, Alpha Corp discloses its 50% stake, the venture's activities, and its share of assets, liabilities, and profits. Any commitments or guarantees to the joint venture are also disclosed. For an associate, Services Inc. would report its 30% stake in Connect Solutions Limited, the country of incorporation, and financial summaries using the equity method. If there's a market price for the investment, that's disclosed too. For unconsolidated structured entities like Finance SPV, Bank Group explains the entity's purpose, assets transferred, and any retained interests or support provided. These disclosures reveal the company's maximum exposure to loss, even if the entity isn't consolidated. Such examples show how IFRS 12 brings clarity to complex relationships. Users can better assess risks and the true financial position of the reporting company. IFRS 12 disclosures benefit investors, creditors, regulators, and even company management. Investors gain a clearer view of risks, earnings quality, and the impact of group structures. Lenders can better assess leverage, creditworthiness, and potential obligations from unconsolidated entities or joint ventures. Regulators use these disclosures to monitor systemic risk and ensure financial stability. Standard setters get feedback for improving future reporting standards. Management benefits from a deeper understanding of group risks and interdependencies, supporting better decision-making. The process of preparing disclosures can strengthen internal governance and risk management. Ultimately, IFRS 12's transparency supports market confidence and fair valuation. It's not just compliance, it's good business practice. Failing to comply with IFRS 12 can lead to fines, public censure, or even suspension of trading. Beyond penalties, poor disclosure erodes trust, damages reputation, and raises the cost of capital. Investors may lose confidence, share prices can fall, and legal action may follow if stakeholders suffer losses from misleading statements. Non-compliance also undermines comparability, making it harder for users to evaluate companies across borders. Consistent application of IFRS 12 is vital for global capital allocation and market integrity. The standard's strength lies in enhancing transparency and comparability. By requiring clear, comprehensive disclosures, IFRS 12 empowers users to make informed decisions. Adhering to IFRS 12 is a mark of good governance and accountability. These disclosures are essential for market confidence and the stability of the financial system. In short, IFRS 12 is fundamental to trust in financial reporting.